Hello there learners. Welcome to the first video of Module 5 of the MOOCs entitled Rural Development in India. In this video, we'll discuss concept of rural credit, need for rural credit, role of credit in rural development, types of rural credit in India, sources of rural credit, especially the non-institutional sources. India is predominantly an agricultural and village-based society. It has been said and believed that India lives in its villages. According to recent data, as of 2019, there are a total of 6,64,369 villages, up from 6,40,867 in the year 2011. So before going to the content, let us have an idea about India's rural economy. According to Census 2011, 68.85% of India's population resides in rural areas, and it is projected by Niti Aayog that it will remain above 50% even in 2045, indicating the sustained significance of rural India in the nation's socio-economic fabric. If we look at the table, we can observe that the number of rural population in India, it is increasing, but as a percentage, it is decreasing. So as of, according to the data of 2011 census, 68.84% of the total population of India lives in rural areas. The Tendulkar methodology shows rural poverty was alarmingly high at 41.8% in 2004-05, declining to around 25% in 2011-12. However, 6 states still had poverty ratio exceeding 35% in 2011-12. The rural monthly per capita consumption expenditure remains significantly lower than urban levels, indicating limited consumption capacity and acute poverty. Though data of 2011 is a bit old, but we have to use this data in most of the cases as it is the official data and no census has taken place thereafter as of now. The periodic labor force survey report 23-24 highlights that the rural employment is largely characterized by self-employment, which constitute 53.5%, and casual laborers, which constitute 25.6%. A significant portion of rural workers, that is 58.4%, is engaged in agriculture, which offers seasonal employment. Salary jobs in rural areas comprise only 12% of the workforce, with most of these positions lacking contracts, paid leave, and job security. This signifies the importance of rural credit in India. Based on the latest available All India Debt and Investment Survey conducted in 2019, the share of outstanding cash debt from non-institutional sources of rural credit in India was 34%. This is a significant decrease from previous decades, but shows that informal credit sources still play a substantial role, particularly for vulnerable households. So this was an introduction about the rural areas of India. Now let us know what we mean by rural credit. Rural credit is financial assistance in the form of loans and other services provided to people in rural areas, primarily for agricultural and related activities. Now, why the rural people need credit? So there are different credit needs in the rural areas. To meet their varied needs, this can be also called as type of rural credit. People living in rural areas require finance to meet their various type of developmental as well as consumption needs. The classification of rural credit can be done as follows. On the basis of time period, if time period is taken as the basis of classification. The rural credit needs can be classified into the following type. Number 1 is short-term credit. When rural households require finance for a short duration of less than 1 year to meet daily consumption needs or to run small economic activities like petty trade, livestock feeding, cottage industries, etc., they take short-term credit. This type of loan is often repaid after receiving income from sale of proceeds or wages. On the time period, the second credit need is medium-term credit. Medium-term credit is required for a period ranging between 1 year to 5 years. It is usually taken for purpose such as repairing of houses, purchasing livestock, establishing small rural businesses, or buying tools and equipment for income generating activities. Repayment depends on income cycle of the households. The third credit need on the basis of time period is long-term credit. When rural families need funds for longer duration, ranging from more than 5 years up to 20 years, they opt for long-term credit. Such finance is needed for construction or renovation of houses, then digging of wells or tube wells, buying agricultural land, establishing rural enterprise, or repaying accumulated past debt. Long-term loans are generally repaid in installments over many years. Rural credit requirements also vary based on their end uses. Therefore, they can be further classified into following types. Number 1, productive credit. This type of credit is taken to support economic activities and to generate income. It includes loans for purchasing livestock, seeds and fertilizers, tools for handicrafts, and raw materials for cottage or small-scale industries. It also includes credit for investment in rural micro-enterprise. Productive credit helps improve the economic condition of rural households. Second one is unproductive credit. Rural people may sometimes borrow to meet social or personal obligations such as marriage, festivals, religious ceremonies, medical treatment, or other emergencies. As these expenses do not contribute to income generation, such credit is termed unproductive credit. Though necessary for social obligation, these loans often add to the financial burden of the rural poor. The third one is emergency credit need. Credit also fulfills unforeseen and urgent credit needs such as hospitalization, accidents, natural calamities, sudden loss of income, etc. This type of credit is crucial, helping rural households to cope with unexpected financial crises when savings are insufficient. Let us discuss the role of rural credit. Credit or access to timely and affordable finance act like a strong support system. It empowers rural families, boosts agriculture and businesses, and strengthens infrastructure. Let us understand how credit contributes to rural development in India. Number 1, promoting income generating activities. Credit helps rural people start or expand income generating activities such as dairy farming, poultry, handicrafts, fisheries, and small shops. With the help of borrowed funds, they can buy raw materials, tools, and equipment, which leads to higher earning opportunities and more stable livelihoods. The next is supporting agricultural development. Agriculture is the backbone of rural India, since most rural households depends on farming. Credit plays a crucial role in agriculture. It allows farmers to purchase quality seeds, fertilizers, livestock, machinery, and hire labor when needed. This financial support boosts agricultural productivity, improves crop quality, and helps farmers adopt modern and sustainable farming methods. The next is enhancing rural infrastructure. Credit is also used to create and improve rural infrastructure such as irrigation facilities, small storage units, rural roads, wells, and power connections. Better infrastructure increases farm efficiency, reduce wastage, and connect rural producers to wider markets, which creates a new economic opportunities for whole communities. The next is reducing poverty and rural indebtedness. Affordable credit helps poor households meet their basic consumption needs without falling into debt trap with local moneylenders. This may lead to increase their income and gradually escape from poverty and indebtedness. Improving social welfare and living standard. Credit is not only for business purpose, it also helps families improve living conditions. Loans can support housing construction, sanitation facilities, education, and healthcare. By improving basic needs, credit enhances dignity, stability, and overall welfare in rural society. The next is boosting rural entrepreneurship and innovation. With financial backing, rural youth are encouraged to explore new ideas, such as food processing, repair services, local manufacturing, and digital services. Credit provides the initial push required to transform these ideas into business, increasing employment and reducing the pressure to migrate to cities. The next is promoting financial inclusion. Access to credit connects rural people to the formal banking system. Over time, this builds habits of savings, responsible borrowing, financial planning. A financially included rural population is more empowered, informed, and secure. The next is empowering women and marginalized communities. Loans provided through self-help groups and rural cooperatives give women greater participation in economic activities. With access to credit, they can become entrepreneurs, contribute to household income, and gain more respect and decision-making power within the family and community. So this was all about the role of credit that can play in rural areas. Now let us discuss who provides rural credit. As rural people require credit for agriculture, small business, consumption needs, and emergencies. To meet these diverse financial requirements, they depend on both institutional or non-institutional source of credit, that is organized and unorganized source of credit. Now, what is institutional or organized source of credit? So these are organized sources that operates under government rules and regulations. They provide loans at reasonable interest rate and ensure safer and more reliable access to finance. On the other hand, non-institutional or unorganized source of rural credit are those sources of credit which are informal and often serves higher interest rates. However, rural people still depends on them because they offer quick and flexible loans without paperwork. As we discussed that the share of outstanding cash debt from non-institutional sources of rural credit in India was 34% during 2019. This is a significant decrease from previous decades, but shows that informal credit sources still plays a substantial role, particularly for vulnerable households. Let us discuss various sources of unorganized sources of rural credit. The number one source is moneylenders. Who is moneylender? Moneylenders are individuals or small family-based enterprises who provide credit to rural households from their personal funds. They typically operate within local areas and have direct contact with the borrowers. There are two types of moneylenders in India. One whose main source of income is money lending, and other who combined money lending business with other activities. The latter include big farmers, merchant, traders, or commission agents. They are known by different names such as Sahukars, Mahajan, Seth, or Baniyas. They are individual enterprises or family partnership. Their method of operation differs almost from moneylenders to moneylenders. The next source of unorganized credit or non-institutional credit is indigenous bankers. Indigenous bankers are private individuals or family-owned firms who accept deposit and lend money as a regular business activity. Their operations resemble traditional banking, but they function outside the formal regulated banking system. They also deals in hundis, that is the indigenous bill of exchange used for trade credit. They are known in different names in different parts of India, like Srofs in Gujarat and Western India, Seths in North India, Settis and Settiers in Tamil Nadu and Southern India, Marwaris and Multani bankers in trade and industry regions. These groups have a long history in India and played the role of commercial banks before modern banking developed. Another unorganized sources of rural credit is traders and commission agents. These are intermediaries or shopkeepers who provide credit to farmers in the form of cash or input supplies such as seeds and fertilizers, and recover the loan later when crops are sold through them. For example, a trade financing farmers and buying their produce at low price. Another unorganized source of rural credit is landlords. Landlords are big landowners who give credit to tenant, farmers, or laborers based on their economic or social dominance, often linking the credit with labor or tenancy obligations. Another unorganized source of rural credit is friends and relatives. Many a time, rural households take loan from people who share social or family relationship with the borrowers, usually without interest and based on mutual trust for meeting emergency needs, such as for marriage or medical treatment. Rural people often borrow money from the unorganized sector, comprising moneylenders, traders, commission agents, and relatives due to the unavailability of formal banking facilities, lengthy procedures, and urgent cash needs during sowing seasons or emergencies. However, This reliance comes at a tremendous cost, as these sources are plagued by severe drawbacks that perpetuate poverty and exploitation rather than providing genuine relief. Let us discuss its drawbacks. So, number one is exorbitant and unregulated interest rate. The most significant drawback of unorganized sector credit is the exorbitantly high interest rates charged by moneylenders and other informal lenders. Unlike institutional sources such as banks and cooperatives, which operate under strict regulatory guidance and charge reasonable rate between 7 to 12% per annum, unorganized lenders impose rates that can range from 50% to 100% or even higher annually. In many cases, the interest is compounded daily or monthly, making the effective rate several times the normal figure. The predatory pricing stems from the lenders' complete lack of oversight, their willingness to take risk without collateral enforcement mechanisms, and their exploitations of borrowers' desperate circumstances. Then, perpetual cycle of indebtedness. Indebtedness emerges as the most devastating and pervasive drawback of unorganized sector of credit, transforming temporary financial needs into lifelong or even generational burdens. When farmers fail to repay the loan due to the crushing weight of high interest, they are compelled to adopt the practice of loan shuffling, where they borrow a fresh amount from one lender to settle due with another. This merely postpones the inevitable crisis with exponentially increasing the total debt load. Over time, the accumulated burden becomes perpetual, passed down from parents to children as an inescapable family obligation. This perpetual indebtedness not only drains household resources but also destroys productive capacity, as money earmarked for farm improvement, education, or better seeds is diverted entirely towards debt servicing, ensuring that poverty remains entrenched across generations. The next is exploitative and coercive recovery practices. Unorganized sector lenders employ ruthless and coercive methods to recover their dues, which inflict profound economic, social, and psychological damage on borrowers. Lacking formal legal resources, these lenders resort to public shaming, physically intimidating families, or seizing essential assets like livestock, farming tools, and standing crops without due process. In many instances, farmers are forced to sell their product to the very lenders at arbitrarily low price as a condition of the loan. Mortgages on land are another common tactic, where lenders gradually assume ownership through manipulated repayment terms, leaving landless farmers who once owned small plots. These practices creates an atmosphere of constant fear and humiliation, eroding the borrower's dignity, mental health, and ability to focus on productive work. Tragically, this exploitation has contributed to thousands of farmers' suicides in rural areas. The next is absence of transparency and legal protection. Another crucial drawback is the complete lack of transparency and legal safeguard in unorganized credit transactions. Loans are rarely documented with proper agreements, interest calculations are unclear, and terms can be altered unilaterally by the lenders at any time. Borrowers, often illiterate, signed verbal agreements or thumb-printed documents without understanding the full implications, making it impossible to seek redress through courts even if they recognize the exploitation. The next is stifling of rural economic development. The problem of unorganized credit have a negative effect on rural economic growth. A large part of farmers' income goes towards paying off loans instead of investing in farming. As a result, small and marginal farmers cannot afford modern tools, high-yield seeds, fertilizers, or irrigations, which keeps crop productivity low. This leads to food insecurity and forces many rural workers to migrate to cities for low-paying jobs. Instead of helping the rural economy grow, unorganized credit often takes money from the poor and benefits a few moneylenders, increasing inequality and preventing long-term rural development. Despite the very high interest rate and exploitative practices of moneylenders, traders, and commission agents, rural people still rely on them. This is because of urgent financial needs, limited access to formal banks, and long-standing social and economic conditions that leave them with few other options. Some of the reasons are urgent and immediate cash requirement. So why rural people or the rural households depends on the unorganized sector? Because number one is the urgent and immediate cash requirement. The primary reason villagers turn to unorganized sector is the pressing immediacy of their financial needs, which cannot wait for the slow-moving process of formal institutions. Agricultural operations on rigid seasonal timelines, farmers must purchase seeds, fertilizers, and bullocks right at the onset of the sowing season, often within days, or risk losing an entire crop cycle and facing starvation. Similarly, sudden emergencies like medical treatment, weddings, funerals, or natural disasters demand instant cash that banks cannot provide. Moneylenders operating from within the village itself disburse funds within hours, sometimes even at midnight, with no questions asked about the purpose or elaborate paperwork. Inaccessibility and exclusion from formal banking system. Formal institutional credit from banks, cooperatives, and microfinance institutions remains largely inaccessible to the majority of rural people due to geographical, procedural, and eligibility barriers. Most villages lack bank branches, with the nearest one often located 20 to 50 kilometers away, requiring costly and time-consuming travel on poor roads. Even when branches exist, the loan application process is daunting, requiring land documents, income proofs, guarantors, and collaterals that small and marginal farmers simply do not possess. Illiteracy further compounds the problem as villagers struggle to fill complex forms or understand bureaucratic jargons. Banks impose strict creditworthiness criteria, rejecting those without bankable assets or steady income records, leaving landless laborers, tenant farmers and women-headed households entirely excluded. In contrast, moneylenders requires no such documentation. They assess credit based on personal knowledge of the borrowers and family history, making their loans the only practical optional available. Unorganized lenders provide a level of flexibility that formal banks often cannot match, which makes their high interest rate acceptable to many rural borrowers. Farmers can delay repayment during drought or poor harvest without facing immediate threats of foreclosure, although interest may continue to accumulate. Loan amounts are tailored to exact need, whether a few hundred rupees for medicine or tens of thousands for tractor repairs, without the minimum limit imposed by banks. These lenders usually do not require formal collateral like land. Instead, they rely on social pressure, verbal promises, or informal agreements. With no paperwork, waiting period, or rejection letter, unorganized credit offers the quickest and easiest way to borrow in rural areas. Again, villagers often prefer familiar moneylenders over distant bank because of deep personal and social connections. These lenders are usually fellow villagers or from the same community, sharing caste or neighborhood ties that build trust over generations. A farmer knows exactly who he is dealing with, someone who understands his family's struggle, attends the same festival, and may offer leniency during tough time. This relationship-based lending reduces perceived risk and gives psychological comfort which formal banks cannot provide. Banks are impersonal and borrowers are treated as static. Moreover, moneylenders often combine loans with other services such as selling inputs on credit or buying product, creating a support system that formal institution cannot match. Villagers resort to unorganized sources not because they ignore the high interest rate, but because these lenders represent the only lifeline in a system where formal credit is either unavailable, unaffordable in time, or outright inaccessible. The high cost become a forced compromise for survival, immediacy, and reliability, underscoring the urgent needs for exclusive banking reforms that truly reach the rural poor rather than existing only on paper. So with this, we will conclude this video. In the next video, we will discuss about formal sources of rural credit. Thank you for watching this video.